all, I am Swarnam, Assistant Professor of MBA Department of SNS College of Technology. So, in today's session we are going to discuss on the financial market. So, before getting into the session, we shall recap the previous session. So, in the previous session we were discussing on investment and speculation. We have seen the broader aspect of investment and speculation. So, what is investment is all about and speculation is all about. So, in a short, investment you will not do it in a routine aspect. If it is of a speculation, the frequency of trading will be more, and the main objective of investment is to earn a return, moderate return, or the return after few years, or after 2 or 3 years, or after 5 years, whatever it might be. But in case of a speculation, the main motive is to earn high return. So, the frequency of trading will be more. If you have been going for an investment, you do not wanted to go for a high analysis, even a fundamental analysis would be enough. But if you have been going for an speculation, even you should go for a technical analysis. So, everyone cannot go for speculation. The one who has been well enough in trading and the one who has been good enough in understanding the market conditions, they can go for a speculation. So, this is what we have seen in the previous session, and in today's session we are going to see on the financial market. So, we were discussing what is all about financial market. It is a platform where the buyers and sellers involved in buying and selling of the financial products like shares, mutual funds, bonds and so on. So, we are now going to see the classification of the financial market. So, we can classify the financial market on basis of the climb, that is on basis of the climb we can classify it again into debt market and the equity market. Debt market is a market where it offers the debt instruments. So, if it is of a debt instruments, the investor they can claim the fixed claim on their instruments. So, example debentures, bonds, all those things it will come under the debt market. Equity market where they can go for investing in any equity shares of the company. So, equity but the return is not constant. The rate of return in case of a debt market is constant, where they will get a fixed rate of interest, but in case of an equity, the equity shareholder will not get a guaranteed return. Based on the profitability of the company, the return will also change or varies. The next one is based on the climb. So, on the basis of the climb we can classify the market into money market and capital market. Money market means when you have been trading the short term instruments, all those things it will come under the money market instruments. Examples commercial paper, certificate of deposits, treasury bills. So, all these instruments it will come under money market instruments, where the duration is for a short term in nature. And when we tell about the capital market, again we can classify into primary market and secondary market. If you have been trading on the first time, that will be dealt in the primary market. If you have been buying the sold shares, that is what called as a secondary market. On basis of the delivery, we can classify into cash market and future market. Cash market where they can immediately where they will settle immediately, between the settlement will happen immediately between the seller and buyer is what called as a cash market. In case of a future market, the settlement or the deliveries it will be happen in the future date. And we can also classify the financial market on the basis of the organizational structure, that we can say a term as an exchange traded market or over the counter market. When we tell about exchange traded market, it is a centralized market. So, where the trading it will happen on a daily basis, where will have a standard procedure and it will be regulated by a regulatory body, and it will have smooth flow of trading without any mess up and without any malpractices or cheating of the investors. Over the counter market, these are the customized procedure. They do not have any centralized organizations. So traders, they can trade without involving any brokers in their transactions. So if you have been going for an exchange traded, you will buy or sell through brokers, but in case of over the counter, so without the involvement of the brokers, the trading will happen. So over the counter market is suitable for small companies or new companies. So this is what we have seen in this session. So the assessment, coming to an assessment part, can you differentiate capital market with money market? Yes. So when we tell about capital market, it is of a long term perspective. Money market instrument it is something like a short term perspectives. So money market instruments, if you wanted to invest in money market instruments, the investment duration will be less, but in case of a capital market, the investment duration will be more, and it is of like primary market and secondary market, IPOs, trading, all those it will come under the capital market. Money market, commercial paper, treasury bills, all those aspects it will come under the money market instruments. So liquidity will be high in case of money market instrument. Capital market, somewhat the liquidity will not be that much high, where you cannot have more liquidity options when compared to the money market. So thank you for watching the video.